Two of the biggest hit names on the tracker that the Patreons have access to this past week were Sleep Number Corporation and Zillow Group. And that's what we're going to dive into in this video. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help at least 1,000 people achieve financial independence much sooner, and let's get right into it. So as you can see here, in the past week, Sleep Number has been down almost 15%. You can see, of course, second to that of the names that we're tracking is Roku, and then a name a little bit lower on the list, highlighted in green, is Zillow Group. And the reason why it's highlighted in green is because I believe Zillow Group is one of the strongest moat type businesses in its industry, and so that's why I've highlighted green, and you can see that it was down 5%. And let's dive into why these names were down so much. So starting with Sleep Number, you can see that the company is still having supply chain issues. They're still struggling. The company has seen an increase in delays in its first quarter of 2022, with 40% of its products expected to take either 6 or 11 weeks to deliver. And this is not anything new just in the mattress space. This is happening in the boat space that I'm seeing. It's happening all over the place. And so these supply chains are continuing to get challenged at the same time as the consumer starts to slow down. So it's a real big risk overall for these types of companies in this current market. In addition to that, Sleep Number's gross margins have actually declined from close to 63% in the fourth quarter of 2020 to 57% in the fourth quarter of 2021. And that despite the fact that the average revenue per bed went up by almost $400 during that time period. So what this is showing you is that Sleep Number has not been able to increase prices fast enough to make up for the rising costs of making its smart beds. And an article writer notes here that Sleep Number's limited cash, because the company has been using all of its excess cash to buy back shares, has made it so that the company is unable to execute its previous stated Q3 earnings call plan of buying semiconductor chips through higher cost open market purchases and employing new tactics to expedite its shipping and needed supplies, including air freight. So in other words, not having the right amount of capital can hurt you, and in situations like this, they're actually showing that it can hurt them a little bit. Now, they can take on a line of credit to buy all the extra supply that they need. However, that once again adds an element of risk to the business overall by just increasing the amount of debt that the company has. Now, in the valuation that I've provided to the Patreons, I did say that the margins will likely continue to be squeezed in 2022, and I think it can get a lot worse than the 41% that I'm forecasting for all of 2022. It's looking like it's trending in that direction already. We'll see once the next quarter results come out how to sort of like think about this going forward. But overall, in terms of the EPS valuation, the company's balance sheet is weakening. The terminal PE multiple that I'm using is 15 times earnings, which is definitely lower than the average multiple that the company has recently experienced. And so the share price as a percentage of its valuation is now around 70 to 80%. So not necessarily what I would consider buying territory for this name. Now, moving on to Zillow. You can see here that Zillow is actually down almost 5% over the past week. And what's really happening here? Well, notice that people are now starting to get afraid that the month's supply of housing inventory is now at 9 months. But I do want to point out that this metric on its own is a bit misleading because there are much fewer buyers in the market at the moment due to the rising rates. However, this does signal that with fewer buyers and rising rates, home prices are expected to decline, in my personal opinion. And when home prices decline, that effectively brings in other buyers into the market. Remember, the only thing that's impacting affordability right now is the fact that rates are going up and the fact that prices have gone up. So if one of those comes down, it actually increases affordability. So if prices come down, irrespective of the fact that rates are going up, it actually increases affordability for new homes. So it does play the effect of bringing in buyers who've been sitting on the sidelines here. I don't know how much of an effect that will have, but it is an impact that will impact this industry as prices come down. Now, the other thing that I do want to point out is that notice here that the active listing count in the US is still very low. And this is what I mean about that month's inventory seeming a little bit off in terms of a metric on its own, because if you have historically low inventory, but you just have lower number of buyers that are in the market, it's going to make it seem, at least temporarily, that there's an excess amount of inventory, when really it's not that there's an excess amount of inventory. You can see from that chart that there's actually a very low amount of inventory. It's just that there aren't a lot of buyers right now. However, once again, like I said, the only thing that could really happen here is home prices have to come down, and as those home prices come down, I do see more buyers entering the market. Now, the other thing that I do want to point out is that commodity costs are actually coming down for the home space, at least in the shape of lumber prices. So you can see that lumber prices are down from their elevated highs that we experienced last summer and early in 2022. But I do want to point out that at $620, it's still elevated relative to the pre-COVID levels, but once again, it's down considerably from the 2021 highs, and I guess even the 2022 early resurgence that we saw. Now, overall, when it comes to Zillow's valuation, I'm giving them a terminal earnings multiple of 20 times earnings, and they do have excess capital. Now, that's net of their convertible debt and their home segment wind down. Now, one thing that I do want to point out of that $8.80 per share is that does not include the fact that they can earn a gain on the sale of the homes that they are selling off into a market right now where home prices are elevated. So there is a little bit of conservatism in that number. Now, does that $8.80 go to like $15? Probably not, but $8.80 versus like $9.20 is probably something realistic there. But note that the current share price as a percentage of the valuation is under 50%. So Zillow is definitely a name that I do have in my portfolio at the moment. And just looking at the companies that I'm following, notice how Zillow is at the bottom of the 7 names that are currently trading at less than 50% of their intrinsic value. In addition to that, there's 20 names approaching 50% of their intrinsic value. And so in order for you to get access to this list that the Patreons do have access to, you can get it at the lower tier of the Patreon level, and that's just $5 a month. But the other thing that I like to always say is that there's no risk to you, because if you decide to join and it's not for you, no problem. Message me in the app and let me know that it wasn't for you, and I'll absolutely grant you a full refund. So once again, there's no risk to you. And recently I released a video showing how there are early signals for a recession with mounting layoffs. And in order for you to get access to that video, click right here.